Hello friends, my name is Dipesh. Welcome to the video presentation on our latest post for equity investments. How long is long term? Now we all know that equity investments tend to do well over the long term. But the question is how long is long term? As per the tax law, it's just 1 year. So should you be making equity investment for just 1 year? Or should your investment horizon be longer? 3 years, 5 years, 7 years, 10 years, 15 years, 20 years. What should that number be? So now, even though there is no guarantee of earning good returns if you're investing for a very long time, again, the longest subjective, but do the odds of earning good returns improve if you invest for longer periods? So, in this post or in this presentation, we'll try to understand what the data tells us. Have the returns improved for long term investors, or have they remained just about the same? So, I'll quickly there is also a very practical scenario or the problem that a lot of us face. I'll give you an example. For instance, let's say you have some money that you need over the next 3 years. Now, if the data suggests that the odds of earning good returns in equity markets over a year period are not very good, then perhaps you'd be a bit wary of putting that money into the equity investments. You might want to invest that money slightly conservatively. However, if the odds of making money in 3 years in equity markets are high, you would be more inclined to put that money into equity markets. Now, in this analysis, I've considered four indices: Nifty 50, Nifty Next 50, Nifty Mid Cap 150, and the Small Cap Index, which is Nifty Small Cap 250. I have considered only the total returns indices. Again, to reduce my work, I have considered only the month-end data for each of the indices for this analysis. Now, what we will do for all these four indices, we will do a rolling returns analysis. Now, what are rolling returns? Now, rolling returns is a way of analyzing the performance of a particular investment strategy. Now, a common way is you could look at, let's say, how well a particular stock, mutual fund, or index has done over the last 10 years. So today is August 26, 2022. You look at the performance of this investment from August 26, 2012 until August 26, 2022 and assess its performance. But then it's just a snapshot in time. And your analysis will be biased because of the start and the end points. We don't want that. So we'll do rolling returns. So for instance, for Nifty 50, we'll look at if let's say we have to look at 10-year returns, we'll look at all possible 10-year returns that you would have got from July 1919. So for instance, the first data point in that analysis will be the return from July 1, 1999 until July 1, 2009. The second return will be August 1, 1999 until August 1, 2009. So similarly, we'll have multiple windows of or multiple data points for these 10-year returns. This is what we call rolling returns. So this is what I just discussed is point-to-point rolling return. We'll also look at the SIP rolling returns because SIP is a way where how many of us invest into equity markets. So in case of SIP, let's say we are looking at a 10-year SIP returns. So we'll look at the performance of the SIP where you invest for 10 years. So X amount you invest, say rupees 1000 rupees or 5000, 10,000 rupees on the last day of each month for the next 10 years. And then at the end of 10th year, we assess its performance, how that investment, that SIP of X amount per month at the end of each month has done. Right. So first is the first instance, the first rolling type of rolling returns that I discussed were point-to-point rolling returns. This is SIP rolling returns. So I did this analysis for all these four indices, but before that, what should be a good return to expect from equity markets? Now, this aspect is very subjective. Everybody, each one of us will have a different definition of what is a good return from equity markets. So for some, it might be 10% is a good rate of return. For some, it might be 12%. For some, even 20% is not enough. Right? Um, but I'm sure for each one of us, we would want to do better than a bank fixed deposit. Why? Because otherwise, what's the point of taking risk if you don't even do better than a bank fixed deposit? Now, the FD rates have mostly ranged between say 6 to 8%, perhaps 9% over the last 2 decades. So, for me, or at least for the purpose of this analysis, I would want to earn at least 10% from my equity investments, so as to make up for the additional risk that we are taking. Of course, if your target good return is different, then you can view this analysis in that light. Now here's how I have defined the various return ranges. Loss, of course, you make nothing, you lose money. Poor is between 0 and 5%, average is 5 to 10. Good is 10, between 10 12. Very good is between 12 and 15. Excellent is 50. Now these are just random numbers that I've chosen. My idea was to earn more than 10%. So clearly, as an if you're investing, taking risk with your equity investments, you would want to earn good, very good, or excellent returns. Now, clearly, it, it's possible that you will not earn very good returns or good returns all the time for a particular tenure, right? But that does not rule that out as a good. For instance, if let's say 99 out of 100 times Nifty delivers say more than 10% if you invest for more than 7 years. Now, even though there is one instance where you have not done, or 1% chance that you will not earn more than 10%, but these are still good odds. So in this analysis, from the perspective of deciding the ideal investment horizon, I believe there should be at least 80% chance of good, very good, or excellent returns. If that's not the case, then perhaps we need to increase the investment horizon, or at least choose the horizon where the returns are better. So we'll start with Nifty 50. So we'll first look at the point-to-point returns. So if you see one thing which is very secular, very consistent across time frames, across whatever you're looking at, you will see as the time goes by. First of all, the first year, 1 year SIP or point-to-point returns are like toss of a coin. So there is almost 50% chance if you will earn good returns or bad returns. By the way, the definition of good returns remains at more than 10%. Not good or bad returns is less than 10%. Yeah. So you can see the chance of good returns improve as your investment horizon increases. So for 3 year, it is uh, you can see the numbers increasing towards the right for good returns. Yeah. So, and you will see something very similar for SIP performance also. Uh, as your time horizon goes up, your returns also go up, or rather, the odds of earning good returns go up. So in fact, let's say if you look at 10-year period for SIPs, uh, there's a good 90% chance that you will earn more than 10% if you run a SIP in Nifty 50. This is good. Yeah. Um, if we look at so in fact, even for 27-year SIP, there is a good chance. So for point to point, it's about 80%. For SIP, it's about 72, 78, 79% that chance that you will earn good returns. So these are decent odds in my opinion. I'm not. I could have considered SIPs or these point-to-point returns for say 15-year periods also, but then the number of data points would have reduced for the other indices. So that's why I've limited this analysis to only 10-year SIPs. But you can clearly see, and even though I've not done the analysis for 12 to 15-year SIPs, but you can see, looking at the trend, you can expect that as you increase the investment tenure or SIP tenure, the odds of earning good returns go up. I just post also share this rolling returns plot for these charts. So you can see this dip around March of 2020 when markets crashed because of the first wave of COVID. Otherwise, you can see the 10-year returns, if you see, are quite good. Almost always around 10, above 10%, barring for a small short period in 2020. Nifty Next 50, even better returns. A 10-year SIP, you can see there is 97% chance that you'll earn more than 10%. Phenomenal returns. Very impressive. Again, this is just returns based analysis. While you're choosing your investments, you need to look at the volatility also. You need to look at risk adjusted returns. So that analysis I have done in a different post versus in this post, the focus was just on the returns. The focus was to on good returns. I'm limiting myself to just the return numbers. For SIPs, it's about 97%. For a lump sum investments also, it's about 95%, 95%. So phenomenal returns. And you can see, and this shows up here. Right? Very, if you look at 10-year plot, only a very small window in 2020 when the returns rolling returns are less than 10%. Mid cap is also good. In fact, in some cases, it's even better than Nifty Next 50. But it is impressive. The finding is exactly 10-year investment tenure duration is what gives you the best odds of earning good returns. And it was the same in for Nifty Next 50 and Nifty 50 also. Now this small cap performance is a bit unimpressive. It fails to impress. Even for you can see even for 7-year period SIP, there is only about 60% odds of earning good returns. For 10-year SIP, the odds improve quite a bit, but even then they are just about 80%. The 80% is decent, but most of us feel that small cap stocks give you better returns. But if your vehicle of investing in small cap stocks is the small cap index fund, and when I say small cap index, I'm primarily referring to Nifty Small Cap 250 index. There are other indices also around small cap indices. For small cap stocks, this definition of small cap investing is particularly pertains to SEBI's definition of small caps, which says that small cap stocks are those which rank in terms of which rank from 250 first to 500th stock in terms of free float market cap. So not very impressive. For the point-to-point returns, for 10-year horizon, the odds of earning good returns, which is a good return is return more than 10%, are just about 75%, or in fact less than that, about 72%. Not impressive, just not impressive, right? In fact, we will look later that it's not just about the odds, even the average holding returns for a small cap index has been lower compared to the other three indices that we discussed. So, if the small cap index does so badly, how should you look at investing in small cap stocks? So in my opinion, if you want to stick with market cap based indices, I think you are better off investing in the mid cap index. Do not invest in the small cap index. Or however, if you are keen to invest in small caps, you have three options. One is that you need lots of luck. So I think small cap is the index where you will need to enter or exit or both at just about the right time. So you might have some strategy. It could be moving average based or whatever. That's your choice. Something that you need to figure out to invest in small caps. Investing in Nifty small cap 250 index is not for the long term. A buy and hold approach is not a good choice. Or you can alternatively consider and actively manage a small cap fund, but that has its own set of risks. It's quite possible that the small cap fund that you pick up does not do well while the other small cap funds do well. So it's complicated. That decision you have to make. But one thing we know for sure, that Nifty small cap 250 index has not done well. So if you are a buy and hold investor, then and you want to limit yourself to market cap based indices, then this is not the index where you should be investing. You are much better off investing in the mid cap index. So mid cap stocks are also small stocks, perhaps not as per SEBI's definition, but these are also smaller stocks which you can look to invest in. This index has also done far better than the cap based small cap index. Now, if you do a comparison analysis, that's what I was referring to. You can see the small cap index has done the worst across all time frames, whether it's the point to point rolling returns or average of SIP rolling returns. The performance has been the worst. The best performers have been the next 50 and the mid cap 150. But as I said before, this is just the returns analysis. Uh, you might also want to look at the risk adjusted returns, the volatility part of it, because it's easier to look at this data in hindsight. Okay, if you invested this much money in a Nifty next 50 over the 10 years back, it would have amounted to this much. But then this hindsight analysis or looking at data and making a decisions does not consider the part your behavior can play in managing your investments. So we know that Nifty 50 is less volatile than Nifty next 50, and next 50 and mid cap indices are much less volatile than small cap 250. Yeah. So small cap is a clear no-no. Small cap 250 index, simply because we know that it's more volatile, and we also know that it's not giving good returns. So if it was giving good returns, then perhaps that higher volatility might have been worth it. Not now. With this sort of performance, no. One thing more to note is that these are the average returns. That does not mean that you will earn this return for sure. So when we say over the 10-year, if you run SIP in Nifty Next 50, the 10-year returns for SIP have been 15.5. These are the average returns. If you want to look at the best and the worst numbers, you might want to go back to this chart of Nifty Next 50, where you can see 10-year SIPs has gone as bad as 7%, and the highest has been somewhere about 20%. That's a function of timing. Yeah. So, but again, it's difficult to bet on the timing part. We are just looking at the returns part. And yes, so I've tried to consolidate these this return performance in terms of the time is spent in the return range. Like for instance, earlier we had poor, we had loss, poor, good, very good, excellent. In this case, I've tried to consolidate these numbers. So anything less than 10% is poor, and anything more than 10% is good. And I have to try to do this I've done this for all the indices. So you can see good returns improve, or the odds of good returns improve with time. So 5 6 year SIP, they are about two-thirds chance. They two-thirds chance that you will earn more than 10%. But for 10-year SIP, you will earn, there's a 90% chance of earning good returns. For Nifty Next 50, you can see. And in fact, I've highlighted the decent numbers in bold and green, where the odds of earning good returns is high. So for 10-year SIP for Nifty Next 50 and Nifty Mid Cap, the odds are for Nifty it is almost 90%. For Next 50 and Mid Cap 150, these are even over 95%. For a small cap, this number is, even though it breaches our threshold of 80%, but it's not something that inspires confidence. Even in the P2P returns, you will see Nifty Next 50 is about 80%. Nifty 50 is about 80%. There's 80% chance that you'll earn good returns. For Next 50 and the mid cap index, the odds are really high, very very high. Now, what does this all mean? We have done all this analysis, but coming back to the question, where the question was how long is long term. Now, if long term, by selecting that particular long term for you means increasing the odds of earning good returns, then I think you should be willing to give yourself a longer rope, at least 7 to 10 years. Because that's when the odds of earning good returns, at least as per data, are high. Longer is of course better. I have not gone into 12 and 15-year horizons, but given the way equities work and the kind of trend that we have seen in this analysis, I'm sure with the long term, with the if as you increase the duration, your odds of earning better returns will improve, and you can see the chance of good returns improve secularly with it's very consistent across all the indices. Even with the small cap index, as you increase the investment horizon, the returns improve, both for lump sum investments and for the SIP investments. P2P returns are more relevant for lump sum investments when you are looking to make lump sum investments. SIP investments are more relevant for if you're planning to set up SIPs. Um, the caveats, the results are only for buy and hold investor. So if you are a skilled trader and you can time your entries and exits well, then there is a good chance that you might beat the index. But then how many people can do that? Uh, Trading is not just having the skill; it's also about having that good discipline to um, tide through ups and downs. So you must know how to when to get in, when to get out. You must have that investment discipline. You must have that discipline to stick to the investment strategy or what you have tested in your back test strategy. You must know how to size your trades properly. If you can do that, and if you're good at that, you will probably outperform buy and hold. So when we say 10-year Nifty has done this, given average of say 15%, you might do better. But if you can't do that, then you will earn even worse. So on average, people earn 15%. If you don't do your trading job well, you might earn a much inferior return. And in fact, the problem is when you think that you belong to the first category, where which means that you are a good trader, but your results place you in the second category, right? So you think that you are a good investor, you are a good trader, you will do better than the index, but then results show otherwise. Uh, this analysis is also not relevant if you plan to take concentrate bets and invest in specific stocks, because that solely depends on if you have been able to identify that good stock. This analysis is only restricted to broad-based diversified indices. Again, past performance does not guarantee future performance. So what I have shown is the past. The future might be very different. So take this analysis with a, in fact, take any set of backtest results with a pinch of salt. Um, for the Nifty 50 index, we have much longer performance history, And you could also see this in the number of data points that we had for different indices. The Nifty data was available since 1999. Nifty Next 50 was available since 2002, and mid cap and small cap indices data is available only from April 2005. So number of data points is different. The number of data points for the long-term tenures for the mid and small caps are much less, and in some ways that might have affected the performance that you see above. For instance, uh, if an index is launched in 2005, um, all of us know that we had a massive bull run between the years 2004 until 2007 or mid of 2008. So now the long-term data will not have data points for those. So for instance, if uh, if you invested in Nifty Next 50 in 2002 or 2004, it will have the that investment would have completed 3 years in 2007, and we know that that return would have been good. In fact, we can also see this in the rolling returns chart. So in 2007, you can see around this time returns are about 34-35%, right? Now Nifty mid cap or small cap index will not have such data points, because there since they started in April 2005, the first data point that we will have for them will be on March 31, 2008. So this makes this data slightly biased, or this analysis, the numbers that I posted, slightly biased against mid and small caps. So that good chunk of returns which came in 2004 until 2007, that part perhaps is not there for the mid and small cap indices. Having said that, both mid and small cap indices had the same limitation. Still, the mid cap index has done far better than the small cap index. So that part about not investing in Nifty small cap 250 index still remains. That does not change. But it's just that you need to view this analysis in that light. That some of the good performance of 2004 to 2007 bull run, those data points will not show up in this charts and will affect the overall performance of or what I have shown as in the performance analysis for the four indices. That won't show for the mid and small cap indices. And I've considered the TRIs, total return indices, for all the index. Clearly, you can't take exposure to TRI. You can only invest in index funds which have the which have TRI's total returns index as the benchmark. But then there'll be tracking error, and you can expect tracking errors to get worse as you move lower down the market cap. So I would expect tracking errors for Nifty 50 index funds to be lower than Nifty Next 50 index funds, which in turn should be lower than Nifty Mid Cap 150 index funds, which should be lower than Nifty Small Cap 250 index funds. So again, the I would expect the tracking errors for Nifty Small Cap 250 index fund to be much higher than the Nifty 50 index funds on an average basis. They can always be outliers. And yes, finally, um, this is just the returns data. If you and you should not just be looking at returns, because the returns performance does not really show the journey that you underwent to earn those returns. And sometimes if the journey is painful, you might shun the boat midway. So also look at those aspects. So that's why I always speak about having a structure of portfolio as core equity and satellite equity portfolios. Core equity portfolio should be built around large cap index funds, and the satellite portfolio should be built around or rather satellite portfolio should be is an area where you can express your portfolio preferences. So you can, let's say, go with active funds, um, factor funds, even mid and small cap funds. So it's extremely important. So even though Nifty might not show you the best of returns, this should still be part of your overall portfolio scheme of things. So yes, net if you are investing in equities, invest for the long term, at least consider a 7 to 10 year horizon. Less than that, you're leaving a lot to chance. So less than 7 years, I don't think you should be looking at equity investments, and this applies to both lump sum investments and SIP returns. And the longer time, the longer you give yourself, the longer the rope you give yourself, the odds of earning good returns for you will improve. And yes, small cap, I told you, small cap, nifty small cap 250 is not a good index to park your money for the long term. So that's it, folks. If you like the video, please press the like button and do subscribe to the channel. Thank you.